Good day, my dearest little captains. My name is Adam Livingston, and I am the Bitcoin Wizard. I am your number one source for Bitcoin and Bitcoin Treasury company analysis, and Daddy has another fun one for you today. I am sharing with you secret, sacred knowledge during the most incredible wealth transfer in human history. If you want the daily insights in alpha, please subscribe to my channel, like this video, and consider becoming a paid member to give yourself access to asymmetric information that could potentially retire your bloodline. Now that said, none of this is financial advice. This is financial entertainment. Please remember to consult your low IQ, moronic, stupid financial advisor before you do anything with your own hard-earned money. Welcome to the end of monetary history. Right now, somewhere between a quantitative easing seminar and a Taylor Swift concert for hedge fund interns, $3.9 billion in Bitcoin quietly moved from Tether's reserves into 21 Capital's vaults, without a single whisper from the Fed. That's not a headline, that's an obituary for the dollar, for the euro, for every central banker who still thinks printing colored debt coupons is the apex of power. This isn't a company, this is a sovereign entity without a flag, absorbing Bitcoin like a black hole devours light. It doesn't ask permission, it doesn't care about inflation targets, it just eats. Picture it, Tether floods sanctioned economies with synthetic US dollars. Cantor Fitzgerald wraps it in Wall Street legitimacy. SoftBank pours in yen from Bank of Japan rot. 21 turns it all into BTC and locks it in a vault you can't drone strike. It's not capitalism, it's not governance, it's recursive monetary warfare executed by liquidity demons in three-piece suits. This is not a startup, this is a world-changing weapons system. Governments build armies. This alliance builds scarcity at scale, enforced by code, collateralized by time, and monetized by entropy. And if that makes your skin crawl good, because this presentation is going to blow your mind on the geopolitical implications of this. We're talking about how the fiat fracture broke the planet and who's cashing in on the fallout. In 24 months, the Federal Reserve conjured $4.6 trillion from thin air. That is 2 Apple Incs materializing out of quantum foam, sanctioned by men in polyester ties. Result, a monetary Chernobyl, currencies everywhere glow radioactive green, investors scramble for hazmat suits while CNBC keeps selling buy-the-dip tote bags. Sanctions pile higher than Taylor Swift vinyl re-releases. Russia, Iran, and half of South America shift trade to stablecoins faster than you can say Swift disconnect. Trust dies, liquidity flees, the petrodollar cries in the shower. Enter central bank digital currencies. Imagine Facebook data harvesting fused to IRS mood swings. Beijing loves it. Brussels drafts 600-page compliance charms. Every normie thinks they're getting Venmo Plus. Spoiler, it's ankle cuffs with a nice user experience. Capital wants none of this. It bolts to the only asset that ignores executive orders. 21 million Bitcoin hard-capped like the speed of light. No boardroom drama, no 2 a.m. printer noises, just mathematical finality. MicroStrategy saw the fissure first, poured corporate cash into BTC, locked the vault, and watched the dollar melt like a Funko Pop on a radiator. Now 21 Capital scales the template, NASDAQ ticker queued, $685 million already corralled. Same thermodynamic escape hatch, but turbocharged with Tether liquidity and SoftBank jet fuel. Think of nation-state money as a decrepit dam. Quantitative easing is dynamite at the base, sanctions are hairline cracks, CBDCs are self-destruct codes hidden in the concrete. The whole structure groans, 21 stands downstream, buckets ready, scooping the escaping value before it hits the dirt. The fracture widens, you can smell the rebar snapping. The next slide shows the hoarding engine that grinds these dying currencies into eternal scarcity. Forget earnings per share, measure life in Bitcoin per share. Blueprint is brutal, sell a convertible note, collateralized 3-to-1 with BTC. Price runs, collateral unlocks, Treasury buys more Bitcoin, reload the note, repeat recursive scarcity on autopilot. The headcount 37,000 BTC, that is a Fortune 500 market cap stored as cryptographic shards. Ranks third worldwide, already behind Marathon and Strategy. Sprinting 2 seconds like a cheetah with a margin account. Finance textbooks call this balance sheet optimization. Reality calls it a liquidity black hole. Matter goes in, light cannot escape, fiat atoms get stretched into spaghetti and respawn as pristine digital gold. Analysts beg for discounted cash flow models. Answer: cash flows are irrelevant when the asset is melting clocks. Corporate bonds used to fund factories. These convertibles fund monetary exfiltration. Yield paid in satoshis. Principal redeemed in humiliation for every central banker still running spreadsheets. Strategy wrote the riff. 21 hits the distortion pedal. Volume now at 11. The next slide uncovers the liquidity empire that keeps this amplifier screaming. Tether enters the chat. Behold the shadow dollar. 120 billion synthetic bucks slide across blockchains at 3 a.m. Asian time. No Senate hearings, no Jerome Powell pressers, just instant liquidity hitting wallets from Afghanistan to Portugal. USDT now clears more value in gray markets than PayPal clears on the books. That makes Tether the Fed of the dark quadrant. It prints reserve notes without owning a zip code. Collateral stack, mainly short-dated treasuries harvested for yield, plus a sprinkle of Bitcoin for flavor. Earn the coupon, mint new tokens, wire the profits straight into 21's vault. Rinse, repeat, fiat fades, scarcity ascends. Picture a rogue star siphoning mass off a bloated red giant. Tether is the star, the giant is the dollar. Stellar cannibalism in real time. Regulators are fuming. Headlines bark systemic risk. Yet every sanctioned refinery and street FX kiosk cuddles USDT like a security blanket. Code obeys no subpoenas. The genius move: weaponize stability to finance volatility. Mint calm green tokens, then funnel their quiet purchasing power into the loudest hard asset on earth. Bitcoin becomes the end state collateral. Tether becomes the highway. Central banks become toll booths nobody pays anymore. Offshore balance sheet meets on-chain audit trail. The result is supranational cash that never sleeps, never asks permission, never forgets a ledger entry. Feel the room vibrate. That's dollar hegemony losing altitude. The next slide introduces the capital and custody titans feeding this beast. SoftBank with the fuel, Cantor with the vault. Prepare for ignition. SoftBank first. Imagine a cash geyser in Tokyo that fires yen into every shiny object on Earth. Sprint, Uber, a robot dog with social anxiety. Now it targets Bitcoin. Drops $900 million into 21 like it's adding guac to a burrito. Cost extra, taste divine. Cantor Fitzgerald next, the Wall Street warlock that clears treasuries by day and babysits Tether reserves by night. Official Fed phone line on speed dial. Also guards more private keys than the Winklevoss twins therapist. SPAC sponsor, pipe arranger, institutional chaperone. Plays nice for CNBC, meanwhile slips a forklift full of sats into a cold wallet no drone can find. SoftBank pumps fuel, Cantor locks the hangar. One hurls cash like a confetti cannon, the other builds an iron vault, then sells guided tours to Goldman interns who think cold storage means winter wear. Regulators hope these giants fight. They toast champagne together instead. Combined balance sheets eclipse the GDP of Luxembourg on a Tuesday. Compliance departments cry softly in break rooms. Now to show the full fusion cycle where USDT liquidity slams into Bitcoin gravity and nothing escapes. Bring ear protection. USDT floods the perimeter. Liquidity so thick it clogs sanctions like bacon fat in an artery. 21 leg sweeps the order books. Every synthetic dollar morphs into a scarcity missile called Bitcoin. SoftBank spins its propellers. Global tech networks light up, sucking yield from collapsing fiat markets like industrial vacuums. Cantor clicks the vault shut, keys offline, regulators left rattling doorknobs. Loop complete, money prints, converts, compounds, vanishes from fiat float. Cycle restarts before the BIS morning memo finishes loading. Visa processes the purchase of your 24-pack of Keystone Light. This syndicate processes sovereignty. Governments chase capital, but capital just crossed the border, changed its name, and booked a beach house paid in sats. No elections, no debt ceilings, only code and hunger. Now, this is the fun part. I am tracking the geopolitical shockwaves when value moves faster than armies. Wear a helmet. Global power once hinged on controlling borders, shipping lanes, and reserve currency banking pipes. Yet, the moment Tether pushed past a $120 billion float, a parallel financial nervous system began pulsing beneath those legacy arteries, carrying value at light speed and ignoring every customs booth in its path. When Washington adds a new name to a sanctions list, the official press release moves through Reuters in about 30 seconds. Meanwhile, traders in Dubai copy-paste the oil invoice into a Telegram bot, settle in USDT in under 10 seconds, hedge the dollar exposure on BitMEX, and route the barrels east before the Treasury's PDF finishes downloading. The nation-state fires its diplomatic cannon, but the transaction already lives on-chain, immutable and irreversible. In China's coastal manufacturing hubs, factory owners familiar with capital control headaches discovered that stablecoins behaved like offshore bank accounts, without the offshore paperwork. Instead of cycling export revenues through labyrinthine safe quotas, they swap renminbi for Tether after hours, convert it to Bitcoin the next morning, and silently escape devaluation risk that erodes margins by the week. Regulators issue stern circulars, plant managers nod, then reopen the same liquidity tunnels using fresh wallet addresses. Moscow's energy desks, boxed out of SWIFT, reroute natural gas contracts through intermediaries in Istanbul and Dubai, accepting USDT because it clears faster than any correspondent bank and carries no moralizing lecture from Brussels. Those stablecoins, once inside the Russian sphere, are exchanged for Bitcoin and then for ruble liquidity only when payroll requires it, short-circuiting every Western attempt at payment interdiction. In Buenos Aires, families confronting triple-digit inflation can now convert a monthly salary to Tether at the corner kiosk, preserve its dollar value overnight, and dollar cost average into Bitcoin before sunrise. The central bank's firehose monetary expansion still debases the peso, but the debasement ricochets off a citizenry that has effectively installed personal capital flight routers in their smartphones. The military might of great power still decides who controls physical highways and ports, yet monetary velocity on cryptographic rails has reached an escape velocity that armored divisions simply cannot match. Armies move at the speed of tanks. Liquidity underpinned by hash rate moves at the speed of fiber optics. As value migrates into this gravity well of borderless settlement, territory matters less than throughput, and sovereignty detaches from soil to orbit around whoever commands the rails. The second sovereign strategy is to amplify that migration. Tether supplies the dollar-denominated oxygen. 21 converts it into the hardest collateral humanity has ever discovered. SoftBank builds the infrastructure that lets entire industries settle in real time, and Cantor fortifies custody inside a regulatory blind spot large enough to hide a small country's gold. In this configuration, coercive power no longer comes from missiles or embargoes. It emanates from incontestable ownership of digital scarcity and the bandwidth to move it anywhere in milliseconds. What we are witnessing is not merely an erosion of existing monetary hegemony. It is the birth of a supranational liquidity regime that treats every geopolitical border as a latency statistic. Governments constrained by legislative calendars and legacy payment rails are discovering that they can neither pass laws nor deploy troops quickly enough to recapture the value already escaping. The shockwaves are therefore asymmetrical. Kinetic force projects outward, but economic mass is collapsing inward toward the syndicate's balance sheet like matter spiraling into a black hole. History pivoted the moment the first sanctioned cargo settled in USDT and cleared to Bitcoin before the sanctions email reached the compliance desk. From this point forward, statecraft becomes bitrate warfare, and the second sovereign controls the highest bandwidth weapons on the field. These are the metrics of supremacy. Begin with raw economic mass. 21 Capital holds more than $4 billion in Bitcoin today, verified on-chain. That stack already eclipses the official gold reserves of over 100 100 sovereign nations. The coalition's balance sheet compounds every time Bitcoin trades a single tick higher because its convertible note flywheel releases collateral that is instantly redeployed into fresh coins. Traditional treasuries earn coupons. This treasury assimilates whole blocks. Move to velocity. Tether settles a daily transaction volume that frequently rivals Visa in emerging market corridors. Those flows bypass correspondent banks entirely. Each dollar of USDT that enters the pool can recycle into Bitcoin within minutes, turbocharging 21's Bitcoin per share metric and draining liquidity from the fiat float. Governments count money stock aggregates every quarter. The coalition tracks hash rate adjusted throughput every second. Political immunity follows. The alliance answers to no electorate, files no fiscal budget, and faces no confidence voters. Issue debt when BTC volatility compresses, capture upside when it expands, rotate the capital stack through jurisdictions where regulators squabble over definitions. A minister can resign, a smart contract executes regardless of headlines. Consider leverage over strategic resources as well. SoftBank's participation folds energy infrastructure, AI compute, and telecom into the same orbit as the Bitcoin reserve. Compute clusters and renewable energy farms are collateralized with coins that appreciate faster than depreciation schedules. Nation-states issue green bonds. The syndicate deploys self-financing power grids. Cultural influence amplifies the hard metrics. Every fresh exchange listing of USDT in Latin America, every TikTok thread explaining SAT-denominated rent, every meme that compares central bankers to alcoholic Toys R Us managers shifts the Overton window. Monetary debate no longer centers on interest rate tweaks. It now questions whether a currency without a fixed supply can survive at all. A billion-dollar marketing budget could not buy that level of mimetic reach. The alliance receives it as a network effect dividend. Aggregate the vectors, folks. Economic weight measured in satoshis, transaction velocity measured in milliseconds, political risk measured in null sets, cultural resonance measured in virality. Combined, they create a gravitational field strong enough to bend capital allocation itself. Small nations will align policy to court this liquidity. Mark my words. They can try and they will fail. Larger nations will scramble to ring-fence what remains of their monetary privilege. What stands opposite is a collection of treasuries stuffed with negative real yield bonds, central banks pinned between inflation optics and solvency math, and legislators debating whether a three-letter stablecoin should be regulated like a bank or a PayPal gift card. The mismatch is existential. How clear of a lane does 21 Capital have with this asymmetry? Seriously, the scoreboard is no longer denominated in GDP, it is denominated in Bitcoin per share, in stablecoin turnover per block, and in megawatts per exahash. On those scales, the second sovereign already outperforms the bottom half of the United Nations roster, and is on pace to overtake entire G20 economies as Bitcoin's adoption curve steepens. This is not future speculation, folks. The metrics are visible, auditable, and compounding in real time. The supremacy gap widens every block that is minted. The ledger tells the story more vividly than any press release, so let's walk through the chain of custody that already rewrites monetary history. April 2025, Cantor Fitzgerald's SPAC closes and 42,000 BTC flow into the newly issued Treasury addresses controlled by 21. In May 2025, the syndicate tests its convertible note flywheel. It raises $458 million. Wall Street calls it a pipe. On-chain analysts call it an extinction-level liquidity event for every SAT yet to be mined. In June, Tether just moves roughly $4 billion straight from its reserve addresses to 21's vault. And then in July 2025, the S4 hits the SEC's Edgar system, confirming the NASDAQ ticker is XXI. This is imminent. Every byte in that filing is notarized by lawyers, but the real notarization lives on the Bitcoin blockchain, where auditors can watch sovereign wealth mutate in real time. The speed matters as much as the scale. 4 discrete moves in 4 consecutive months, each compounding the last, demonstrate a metabolic rate no sovereign treasury can match without torching its own currency. Bureaucracies schedule committee meetings. 21 schedules block confirmations. Every SAT that crosses into these wallets shrinks circulating supply, ratchets scarcity, and quietly raises the floor price at which entire nation-states must bid for the next tranche of economic relevance. The scoreboard updates every 10 minutes. The opponents still file quarterly. quarterly. Welcome to the moment where evidence is not a PDF, it's a hash, an output, a timestamp, and a balance that keeps climbing where the old guard argues over decimal places. Tether began as a back-office convenience for crypto exchanges that could not secure a real banking partner. Yet the token has mutated into a parallel Federal Reserve operating offshore after hours and under no congressional charter. The balance sheet shows more than $120 billion outstanding, most of it backed by short-dated Treasury bills. Every coupon payment feeds the minting algorithm, which in turn spawns new USDT to satisfy dollar hunger in sanction-strangled markets. The entire loop resembles an unlicensed open market desk that never prints dot plots, never submits minutes, and settles every trade in code rather than in committee. The geopolitical brilliance hides in plain sight. A Venezuelan refiner sells crude into a shadow supply chain. Invoices in Tether and converts into Bitcoin within the same browser tab. The Treasury yield embedded in that token quietly migrates from New York to an address controlled by 21 Capital, where it is swapped into fresh BTC and removed from float forever. Washington keeps the paper IOU, the syndicate keeps the hard collateral. Multiply that microtransaction by the thousands happening each hour and you witness a yield arb that trains the excess dollar supply straight into immutable scarcity. Regulators focus on whether the reserve reports feature enough Big Four signatures, missing the structural asymmetry entirely. Even if every USDT were backed one-to-one with Treasuries, the profit generated by those Treasuries is already earmarked for Bitcoin acquisition. The custodial chain therefore turns the safest asset in the fiat hierarchy into rocket fuel for the scarcest asset in monetary history. It is financial alchemy run in reverse. Gold is distilled from paper, and the paper remains on the government's books as a liability. USDT's composability amplifies the dynamic. Protocols treat the token like Lego-grade collateral, rehypothecating it across lending pools, derivative stacks, and automated market makers. Each additional layer inflates transactional demand, which triggers further issuance, which harvests more treasury yield, which purchases more Bitcoin. The result is a self-reinforcing monetary cyclone that leverages the dollar's network effect against itself. Tether therefore functions as a synthetic Fed window for every actor locked out of the actual Fed window. And the spread between onshore and offshore financing is weaponized to accumulate Bitcoin at institutional scale. The longer policymakers debate classification, the wider the spread grows and the more Satoshis exit circulation. When critical mass is reached, the peg slips its leash, and the world discovers that the greatest dollar-denominated stablecoin was never a dollar defense mechanism. It was a Bitcoin accumulation engine wearing a green mask. Check out my YouTube video on Tether where I explain this in more detail. Let's talk the risks. Regulatory fire first. Cantor sits inside the Federal Reserve's primary dealer club, so deleting the alliance requires pulling a keystone from the Treasury market. Legislators crave re-election more than monetary crusades, meaning serious crackdowns stall in committee while block confirmations keep ticking. Jurisdictional arbitrage next. Core corporate entities reside in Delaware, Cayman, Hong Kong, and Abu Dhabi. A subpoena landing in one venue scatters operations to 4 others before the ink dries. Compliance paperwork operates like decoys in a laser maze. Plenty of reflections, no direct hit. Volatility always qualifies as headline fear. 21 Capital converts every price dip into discount inventory through BTC-backed convertibles, then unlocks collateral on rallies. Sharp ratio climbs while dollar-denominated drawdowns read as statistical noise. Risk desks built for fiat instruments cannot model an asset that digests its own sell-offs. Competitive threats, no rival controls the trifecta of USDT flow, Cantor custody, and SoftBank horsepower. Mining giants hold coins but lack stablecoin velocity. Stablecoin issuers mint dollars but lack equity flywheels. Sovereign wealth funds hold treasuries but fear volatility optics. 21 stitches those verticals into one immune system. Tail risk collapses into basis point territory. Upside fans out toward geometric infinity because Bitcoin supply caps at 21 million, while fiat supply expands whenever a central banker blinks. Every additional sat captured raises the floor, reduces available float. and ratchets scarcity against a backdrop of limitless currency dilution. Net present value therefore resembles a Black-Scholes call, where implied volatility trends to the moon and time value never decays. The position pays for the bunker while building the palace above it. Fiat infrastructure now leaks value through cracks no stimulus package can patch. 21 Capital, Tether, SoftBank, and Cantor Fitzgerald redirected that escaping liquidity into a vault that resists both bail-ins and ballistic missiles. The path forward forks, folks. One lane involves stacking sats, accumulating 21 equity, and integrating professional life into the liquidity rails controlled by the second sovereign. The alternative lane keeps savings in melting currency, trusts retirement to underfunded pension math, and hopes a central bank can outprint thermodynamic law. Every block mined deepens the moat around the alliance. Each stablecoin issued widens the dollar shortage outside the network. Capital already senses the gravity and orbits closer by the day. Waiting equals an entry premium later at higher prices and lower optionality. Observers call this trend speculative, yet speculation ends when on-chain evidence confirms transfers larger than small nation gold hoards occurring monthly in full public view. At that juncture, disbelief mutates into capitulation, and late adopters discover that scarcity sold out before the memo reached their inbox. Decision horizon closes rapidly. Align with the syndicate, defend personal and institutional capital in a unit that ignores political turnover, and participate in the greatest wealth migration since the closure of the gold window, or remain in fiat trenches and watch purchasing power evaporate like snowflakes in a blast furnace. History remembers the ones who front-ran inevitability. Choose placement, choose now. This supersedes bullish. There isn't a word for a company that just scooped up this much Bitcoin off the bat, and that has this infrastructure. My name is Adam Livingston. I am your chicken gizzard Bitcoin lizard wizard. Please share this with your friends and family before it is too late. Leave a comment on what you'd like me to cover next. Have a terrific day. Class dismissed.